Senior fellow Judy Shelton joins me now. Do you see further declines in the inflation rate this year? What's your inflation outlook?
I think inflation is on a path downward, and largely because we've had the success of a supply-side economic agenda under the Trump administration. I really think that we have empowered the private sector with lower taxes, less regulation. And so long as the Fed doesn't try to stifle growth by deliberately inflicting restrictive interest rates, I think we're going to continue to have productive economic growth.
So you don't want to see any Fed rate hikes, but do you want to see a Fed rate cut?
I think we will stay at pause for the rest of this year, but I look for a cut in early 2027. And I think it's because we have a new framework that might be potentially put into use under Chairman Kevin Warsh. And that framework does not have this rote Keynesian reaction to saying economic growth is inherently inflationary. He has already said he doesn't believe there's a cruel trade-off between employment levels and inflation. So he's saying you can have both high economic growth and low inflation and end up with high employment in the process.
It seems like we're heading in that direction. That'll be my opinion, that inflation is cooling a little, and we've got a strong labor market and other signs of real economic strength. Do you think we can get to, say, 4% growth in any of the coming quarters for the whole economy?
I do. And the important thing is that it's generated by the private sector. You need access to capital so that small and medium-sized businesses can have borrowing at a reasonable rate to grow their businesses, expand operations, hire more people. And then the answer to any price pressures is to increase output. The Fed has traditionally only tried to curtail demand, not increase supply. So this would just be a groundbreaking intellectual change to new models, a new framework, and I think much more consistent with the supply side approach. And I see that happening under the intellectual leadership of Kevin Warsh.
You're saying, I think, some remarkably positive things for the stock market. A continuing slight decline in inflation, a strong economy, 4% growth maybe. Market goes up from here?
Well, why not? What's wrong with letting free market forces determine the cost of capital? You know, sometimes if you see longer rates going higher, if it's because of having to raise the interest rate to be a nominal rate that includes the impact of inflation, that's negative. But if there's increased demand for capital, that raises the cost of capital, and that reflects people thinking there are going to be productive opportunities out there where you end up investing the seed corn for a greater harvest, for higher standards of living, for greater prosperity. You want there to be high demand for capital, and you don't want the Fed to pervert the market interplay of supply and demand for capital by trying to manage exchange, or trying to manage the economy and manage the interest on reserve balances. That's what we call the federal funds rate. But it's really how much does the Fed pay banks to leave money sitting dormant in their checking account. And that's been the Fed's strongest tool. And now we have a chairman who's willing to look at working with the other tool, the balance sheet, to bring about the best, most supportive environment for obtaining capital in an economy we hope is devoted to free market capitalism.
Will you come back soon, please, because you have a knack for putting complicated technical arguments into plain English. It was terrific. Judy Shelton.
With pleasure.
Don't be a stranger. See you soon. Lou.